Good morning, traders. Let's see who all we have on here today. Can everybody hear us okay? My screen's a little different today. Wonder if there was an update on this.
I may have changed the layout a little bit.
Okay, totally fine. I just
layout, we can do that.
very cool.
No, nope, not that one. How about this one?
There you go. All right, we'll get it figured out. Let me know if you guys can hear us okay. I assume you can, but double checking while some people come in. We're a little early, or we were. Loud and clear. Thank you, Jeremy. Too loud, Jeremy? I might be. All right. Greg, how's your week going?
It's going great. We're in some really good trades right now. I'm really happy about this.
Excellent. Love to hear more about them. But your show, so I will let you kick it off however you see fit. Looks like we're going to Evergrand. What do you got?
Well, that's just a reminder and a good starting point. So I'll just go over this briefly. With Evergrand, yeah, it's still out there. They have officially defaulted. Okay. It happened even earlier than I thought it would. They have officially defaulted, but I don't hear any terrible implications or repercussions going on in the Chinese market, at least not yet, or in their economy.
Mm-hmm.
I suspect that could come, but we'll just keep an eye on it. And so all I do is start this out to keep it in your consciousness, okay, to keep aware of this. I don't really want to talk too much about it every single week. Okay, so I want to show you something. These are how the market indices were on December 14th, which was yesterday. You can see that the S&P 500 was down 0.51%.
Mm-hmm.
The Dow was only down 0.07%, very flat, really. The Nasdaq was down 0.9%, and the Russell was also down almost the same as the S&P 500, 0.52%. Why am I showing this to you? Okay, what this is one indication of is that the government is meddling in the markets, like I talked a little bit about last week. The government is trying to make it look like we're not going down as hard as we are. I've been talking about the radio announcer I listen to all the time, Gary Kaltbaum, who's also a money manager. He is saying that the government is buying up the Dow Jones Industrial Average stocks in the last half hour of trading to make it look like the market's not going down as much as it actually is. I should tell you that the Dow Jones Industrial Average is by far the most famous, most commonly watched index among amateur investors. And so, if you just look at the Dow Jones Industrial Average, you can think, oh, the market's not really down that much. It's only down, so many percentage points from the high, which might be right now between 7 and 10%. But that covers up the truth. That is, a lot of stocks are down 20, 30%. That's definitely bear market territory. So, along with what they're doing in the last half hour of trading, the fact that we already know that they're buying corporate bonds to prop up the stock market, all of this makes it look like the government is orchestrating a controlled retreat in the markets. That's what it looks like to me, because on more than one occasion, several days, the Dow has been down just slightly, while the S&P 500 and the Russell 2000 and the Nasdaq have all been down more, a lot more. And this is a good example of this. So just be aware of that. This seems to be what's going on. Don't just look at the Dow Jones Industrial Average to say, oh, this is how the market did this week. No. Look at the breadth of the markets, new highs and new lows. Look at what these other indices are telling you. Okay, don't just look at the Dow. All right, so we've talked about Evergrand. We've talked a little bit about these slides. Let's look at, let's do this in a minute. there's something else I need to talk to you about. All option traders need to understand this. And I was a little bit surprised that I've come across some traders who aren't aware of this. As an option trader, whether you're buying or selling options, whether it's a call or a put, you need to understand how it works at expiration or if you get exercised. Okay, you got to understand this. It affects you and your money and your trades. So at expiration, all debit and credit spreads, we are buying and selling options. So option buyers at expiration, in the money options are automatically exercised at expiration. Why is that? Well, because you want to make the money that you did on the trade. Okay, what that means is if you bought a call, you're going to pull the stock or call it away from the seller. Okay, so what that means is you got to have money in your account to buy the stock. If you don't have the money in your account to buy the stock, you're going to get a margin call. Okay, so you need to be aware of that. Same thing with puts. If you bought a put and you let it be exercised at expiration because it was in the money, then you're going to push that stock to someone else. And it's also going to cost you about the same amount of money as if you had bought the stock. You're now short 100 shares or whatever of the stock if you let it be exercised. So you need to have the money in your account for either calls or puts in order to cover the trade. So you just need to be aware of that. Now, of course, what happens if it's out of the money? Well, if it's out of the money, it expires worthless, whether you're buying or selling. Okay. If it's out of the money, it expires worthless. But if it's in the money, you need money in your account to cover buying or shorting the stock. Now, let's say you sold a call against the stock and you have the stock in your account. That's a covered call. That's what they call it. It would just pull the stock away if you sold a put, that is, and you're covered. You don't have to worry about it. But if you don't have the stock in your account, then you need the money in your account to cover it or get a margin call. Now, if you don't want that to happen, and most of us don't actually want to buy or push the actual stock, all you have to do is exit the trade before expiration. So that means for spreads, we have one option we bought and one option we sold. Exit both of those trades. Buy the one to cover and sell the other one to get out. So you're flat. Okay, that's all you got to do is just exit. You can do that on expiration day. That's fine, or the day before. That's about when you want to do it. Okay, so if you don't actually want to buy or sell short the stock and you don't have the money in your account to actually do the stock trade, then all you got to do is exit before expiration. That's if you're a buyer of a call or a put.
I highly recommend having notifications turned on, whatever app you're using, or just have them send you an email. It's really easy to turn on notifications. I haven't used every broker, but like knowing a couple days in advance can save from this, because we have had people who have been exercised. I know there's a couple in particular, but like this, it's really easy to avoid just knowing when that date is. But if you don't have those notifications, it's kind of easy to overlook at times.
Yeah. When you're trading options, you want to pay attention and, watch for these things.
Know that date, that Friday.
Know the day of expiration. Very important. Also, you should watch the market and your option trades at least once a day, just to check in on things, to make sure nothing has happened while you were away. So if you go on vacation or you're away for whatever reason, just be able to, look it up. Now, me personally, I've got it all set up on my cell phone. I'm looking at stocks all the time, even if I'm out doing errands or whatever. I just look at my cell phone, see what's going on. And I can get back quickly, to my desk and place a trade if I need to. Okay, so that's when an option expires in the money. That's only when that happens. Now let's talk about getting exercised. Getting exercised means you sold a call or a put, and the option buyer, who has the choice of when to exercise that option, he exercises that option. You don't have any choice as the seller if you get exercised. When a buyer exercises an option, it is randomly assigned to one of the sellers. Okay, the brokerage randomly does that. Now, here are some facts you need to be aware of. Most of the time, options are not exercised until it's near expiration. A lot of traders, just like us, they don't actually want to take delivery of the stock, and so they exit the trade a day or two before expiration, whether it's in the money or out, or excuse me, only if it's in the money, right? Okay, so most of the time, as a seller, if you sold an option and it's in the money, it's probably not going to be exercised until expiration, but it could be. Okay, it could be anytime it's in the money. The deeper that an option is in the money, the more likely it is to be exercised. Just like we did with our Disney trade, we hit max profit, we got out. And it was a good, perfect trade too, because the stock bounced right afterwards. If you notice that, so we couldn't have hit that any better than we did. Okay, so these are two known historical facts about options trading. Okay, so what does that mean as a seller of options? So the option buyers get to choose when to do the exercise. We're doing selling of credit spreads relatively close to the money when we do the trade. So that's why it's a good idea to exit if the option actually goes to the price of the option that you sold, so that you don't get exercised. Now, again, if you've got, $100,000 in your trading account and you actually let it be exercised and you're forced to buy the stock, you've got the money to cover the trade. It's no big deal. But if you've only got like a $5,000 or $10,000 account, then you're not going to have enough money to cover the trade. If that happens, you're going to get a margin call. Okay, this is kind of scary if you don't understand it. It's not that big a deal, really. You just got to call your broker and make it right and get out of the trade, basically. But this happens all the time to these brokers. Okay, they're familiar with this process. What they really want to see is option traders who are on the ball, that even if they don't have the money in the account to cover the trade, they quickly exit, okay, to cover risk. Brokerages don't like taking your risk. They won't do it. And so they are going to send you a margin call. They'll probably try to scare the crap out of you to send money and all this. If you paid for the Option Accelerator program, then you got the workshop that I just barely did last week. And I talk about how some brokers are a lot better about this sort of situation than others. One of those is my former company, Fidelity Investments. Fidelity is a mutual fund company. They're really good for long-term investments, not so good for short-term trading, especially for options. So just be aware of that. And I can't tell you how every brokerage is going to act in this situation of where you get a margin call or where you get assigned the stock and you don't have the money to cover the trade. Most of the time, as long as you exit, like let's say today I got exercised, I was forced to buy the stock, and then I didn't have the money in my account to cover it. So I just quickly sold the stock that was put to me that day. Same day, get out. Most brokerages are probably going to be okay with that, but I would recommend personally that you call the options trading desk at your brokerage and just ask them how they would cover that particular situation. Honestly, it's been a long time it's been years since I got a margin call. So I wasn't even thinking about this situation for those who have smaller accounts to trade with. Okay. But you just need to be aware of this. And if you actually do get a margin call, don't don't freak out. Don't worry. I heard one of our members got a margin call to the tune of $67,000 or something like that, and he was freaking out. Well, guess what? That's not your risk. The total risk on the trade was only like $500. Okay, so the risk doesn't change even if you are assigned the stock because you should have a call and a put or two call. The one you bought and the one you sold. So your risk hasn't changed, but sometimes the brokerages will call and want you to cough up money, and that's kind of a ploy, really, to put more money in your brokerage account. So just be aware of that. I'd recommend that you call your options trading desk at your broker, ask them how would they handle the situation if you got assigned the stock, you got exercised, and you didn't have the money to cover it. I can't answer that because I don't know how every single broker out there is going to handle that situation. The house rules are a little different for everybody. Okay, so that's what I wanted to talk about and make sure you understood to help keep you out of trouble. I'm always trying to watch your back. Okay. Okay. So, Greg, who is the person you are listening to? The radio announcer who I listen to on the radio, and sometimes I just pull up his podcast. His name is Gary Kaltbaum, Kaltbaum, I think. He's great. I learn a lot from him because he comes up with information that I am not always checking, like the number of new lows versus new highs has been much greater. Number of new lows versus the number of new highs lately, even though the market had only been down a few percentage points. That's good information, and I get that from Gary Kaltbaum when I listen to him. So you can find him. You know what? Let me see if I can find. I think I have the link on it. Hold on one second, okay? Let me see if I can find it. Just a second. I'll put it up on the screen here. Yep, there it is. You can go to GaryKaltbaum.com to listen to his podcast. There he is right there. Yes, you should be able to see him on the screen. Great stuff. His program is called Investor's Edge. Comes on, let's see, just about every weeknight or almost every weeknight. It comes on around 6 o'clock Eastern time here in Florida. Maybe it's a different time where you are. I don't know, but it is a national show, and it's great information. You should listen to this guy. Okay. Roy says the only time that he got an option exercised was right before earnings. Right. And that goes right in line with what I just said. Most of the time, it only happens right before earnings. So if you don't want to have the risk of getting exercised, just exit the position. Okay. Okay, now let's look at some stocks. And if you have some stocks you want me to look at, feel free to put it into the, just type it in. I'll take a look at it with you. My computer is moving pretty slow. What's going on? And I think I just shut down what I wanted to show you. So let's pull it up again. Hold on one second. Okay, our current trade, Snap, is doing really well. Now, this shows you an excellent entry point for these short stock trades that I'm doing right now. Now, incidentally, you may have noticed that I'm doing debit spreads these days instead of credit spreads. What's up with that? Well, it turns out that the market got more volatile. And it's much more conducive to making money by doing debit spreads right now because the market has changed. It's started to really trend down hard and steadily. And as long as that happens, we're going to make more money doing debit spreads. Why? Because stocks fall faster than they climb. They can fall pretty darn fast. And so that's why I'm doing debit spreads, so we can make more money. I know that this is mainly a credit spread options class, but hey, I'm all about making money. So if I can change strategies a little bit to make more money for you guys, I'm going to do it. And I'm going to teach you the hazards and the pros and cons about it. Okay. So that's what we're doing. Now, this is the entry point on Snap. See that? This is the last few months. And this is the entry point right there at the black arrow on Snap. Why is this a good entry point on Snap? Now, when the stock is going up and then pulls back, that's a good entry point to buy a stock. It's called buying the dips. If you flip that upside down, that's what we're doing here. We're selling short the bounces. Okay. So number one, the stock is in a downtrend right here. About a week and a half ago, the stock went up for 3 days, as you can see, right before the arrow. The day before the arrow, we saw weakness and we saw a big tail on top, telling us that the sellers pushed it down intraday big time, sold it off big time that day. The entry point, which is confirmation of the downtrend, the stock's already in a downtrend. It's below the 50-day moving average. So we're assuming that this is just a bounce and that it's going to resume the downtrend, which it did. So when the stock starts to show weakness and on the beginning of the arrow day, it starts to make lower lows. It starts to trade below the candle of the previous day. That's your entry point. And that's going to hold true whether you're buying puts or selling calls above it 55 or selling short the stock. It's all based on the stock. So that's your entry point. Okay. And so we have done really well on this. And in fact, I'm pretty sure I have to go back and look. Let me look at this. But I think we, for Snap, sold a 44 put. So max profit is going to be at 44. We've almost hit it in a week. That's a very nice profit. It's going to be hundreds of dollars per contract of profit. So this is another beautiful trade, just like Disney, our first Disney trade. And if the market keeps going down, this is going to be an entry point that is going to repeat over and over and over throughout stocks, throughout the entire market. We're not going to run out of trades with this setup. Okay, so I want to teach that to you so you understand how it works. Now, one of the reasons why it makes for such a good entry point is because, well, if I'm wrong, I don't lose that much. Let's say I entered this trade at about when the stock was going below 52 bucks a share. I pull the trigger. Well, if it suddenly reverses and goes up to 53 or 54, and then, starts to trend up from there, I know I'm wrong. I know we're not going to get a downtrend from there. And so that's when I'm going to get out with a small loss. And that's going to happen, and that's okay. But considering the stock is already in a downtrend, it's a better than average odds that it's going to continue the downtrend. And that's a beautiful entry point, and we're scoring on this trade today. Okay. Let me show you another trade that we're doing right now. Making money with Disney. So let me go to the Disney trade. 1 second, please. Okay, we already made money on our first Disney trade, and I just entered it again with the exact same setup. Now, let's see, I think we got in a couple days ago. Same setup. On the candle that has the high of 154.66, at that candle, still looks like the stock is going up. The stock, was in a downtrend. So I don't know if it's still going up on that day. But the third candle from the right, that's where it starts to make new lows, lower than the previous 2 days. Whenever it starts to do that, and it probably did it in the morning sometime or midday, that's my entry point. And we are, again, making money on a Disney put debit spread that we purchased. So I'm already up, I'm not sure how much, but it's in the hundreds of dollars on Disney. Again, you got to love it. Nice, clean, smooth trades, easy to read, easy, obvious entry points. Yeah, I like it when it's easy to make money. That's what we're shooting for, baby. Okay, this looks great. I love it. Okay, let's look at Square. Ray wants me to look at Square. Okay, it looks like the entry point, same setup. Looks like the entry point on Square and probably a whole bunch of other stocks would have been 3 or 4 days ago. You get the high day of about 5-6 days ago at 195.28. I don't think I would have entered it on the day after that. I would have entered it as it went to new lows below 185, the second red candle after the high, the temporary short-term high, 195.28, at the near the open. When it starts to cross below 185, that had been the support of the previous 2 days. When it goes below that, I'm suspecting the downtrend to continue, which it did. That's your entry point. So is it too late to enter right here? Yes, it is. I don't know when this thing's going to bounce again. It might keep going or it might not. I really like perfect entry points because it limits your risk. If you set up your trade so that your potential losses are always relatively small compared to your gains, you can be right 40 to 50% of the time and still make a good chunk of money. Okay. And that's what we're aiming to do. We're wanting to make sure that we make money in our trading. We're not guessing. We're not just doing something for fun. We're here to make money. And that's how you do it. Okay. Jeremy, to confirm for the entry trigger, are you waiting till prices fall below the previous day's low or close? Yes, I am. And so again, for this, it would have been the second red candle intraday as soon as it starts to go below the previous 2 days. So the second red candle after the high day a week ago of 195.28. When it starts to go below 185, which it probably did in the morning or maybe around lunchtime, then that's my entry point. And so really to get the perfect entry point, you got to watch these stocks. Excuse me if you hear my dog in the background. He's usually pretty quiet, but I've got a yellow Labrador. So anyway, that's what we're looking for. Okay, we're looking for good entry points to limit our risk and to maximize our profits. Let's look at some other stocks I'm looking at right now. I'm a little bit leery of the Dow stocks, knowing that the government is manipulating Dow stocks a little bit right now. Let's look at Caterpillar. Caterpillar made its high, short-term high, about a week ago. Starting to make new lows as of yesterday, but it went up and then today. So if we enter this trade right now, current prices looks like 199. Where would you put your stop? I would put my stop above the high of today, around 202. That means, as far as the stock goes, you're risking $3 per share. What's the price target on this? Pretty safe price target is the previous support level at 191. The big red candle of about 2 weeks ago at the bottom there. So 191 from where we're currently at is $8 a share. Does it make sense to risk $3 a share to make $8 a share? Yes, absolutely. Stock is already in a downtrend. It just went below the 50-day moving average, looks like. Yeah, this looks like a pretty decent trade. I would consider doing this trade. Now you got to look at the options, see, how much the options are. It's not the perfect entry, but it's still pretty good. Not quite as clean as the previous two examples because of the choppiness a few days ago, but it still looks pretty good. Caterpillar looks pretty good. Let's look at something else. I can't help but think that some of these stocks, if you short them or buy puts, almost anywhere, I would think you might make money. Like 3M has been in a perpetual downtrend. Went sideways there for about a month, a few weeks there, late last month or late October to November. But this thing is just a big lumbering slow come. I guarantee you this stock is going to go down more in the future. Is it going to go down right now? Maybe. Where's our risk? Let's see, we're about 174.77. We could put a stop around 177 and the target would be about 170. Does it make sense to risk, let's see, to risk about $3 a share to make $5? Not to me. No. I want my reward to be at least double what I'm risking. Now, I know it's not an exact, one for one. It's apples and oranges when you consider looking at a straight stock trade versus transferring it to options. When you go to options, you got to look at the prices and all that, the spreads and which strikes you want to choose. But for this, no, I don't like it right here. I want a cleaner entry point because if it's clean, the prediction is more likely to be accurate. I'm more likely to make money with a clean entry point. I don't know. It gapped up a week ago. It might rally up from here. I really don't know. So I think I would let this trade pass me. There's so many trades in the market. You don't have to, you don't have to force it. You don't have to push and wait, force something that doesn't look perfect. Go find a better looking trade than that is my advice. Let's look at something else. Let's look at VEEV. Pretty much the same kind of entry. About a week ago, looks like VEEV topped out at 273.49 on that black candle day. It went sideways for a couple of days, started to make a new low on the second red candle day there. That's when it makes a new low compared to the previous three candles. That's my entry. Now, let's say that we did that. Let's say we entered at about 266, I'm going to call it. If we bought puts at 266 intraday, the second day, the very next day, it went up all the way to 271.45. Okay. That still shouldn't have gotten me out of the trade if I'm either in the stock, selling short the stock, or buying puts. Okay. Because that's just noise. That's just normal fluctuations. The fact that it went back up to the high of the previous day, or that red candle day of 262.65, which is that second red candle, that shouldn't have scared you out, okay? Because that's just normal fluctuations. When it starts to go up to 273 or 4 and starts to hold its level after closing, that's when you need to be worried, because that's when it's starting to show you the buyers are overcoming the sellers. It didn't do that though. It went up intraday and they pushed it right back down, which is what I want to see. and it's been going down since then. Do I want to enter right here? Well, let's see. We're at 261. The closest stop should be the high of the previous day, which is around 268. That's pretty far. That's $7 a share. But the profit target should be around 247. It's about 15. So it's not the best entry, but you could maybe barely get a 2-for-1 profit versus reward versus risk. I don't like it as much as other trades, so I'd rather look for something else personally. Okay, I would have want to have gotten in 1, 2, 3 trading days ago. Okay, so this is not something I would want to enter right here. You'll notice I'm pretty picky. I've learned to be picky because you want to have the perfect setup when you enter. It improves your odds of a profitable trade. So if you don't like exactly what you're looking at, don't force it. Go find something else that looks better. There's only 12,000 other stocks to choose from, right?
So that sounds about right.
Lots of choices there. Okay, so really that's all I have for today. Unless you've got 10 seconds. If you want me to look at one more stock, I'll do it.
Awesome content, Greg. Really appreciate it. Yeah, there's a little bit of a lag, so we can wait for one more ticker if you want, but are we good for next week? I know we're getting close to the holiday season. Did you want to try to schedule one for next Wednesday?
I'm good for it.
Okay.
I'm okay with it. I'd be happy to do it.
Okay. So we'll shoot for that.
Everybody, you're welcome. I'm happy to help you. Doing the best I can to teach you and help you and make sure you know the risks. Because guess what? There's plenty of money in the markets for all of us. So let's all make money together.
Much appreciated, Greg. Okay. Well, if we don't have anything else, any questions, you can email Greg at options@thetradersplan.com. And otherwise, we will see you next week.
Thanks, everyone. Have a great week.